Hello, everyone, and welcome to another Wall Street for Main Street podcast. Today we have a returning guest. His name is Chris Marchese. He is an economic and equity analyst for the Morgan Report, and he is also a co-author of his new book, The Silver Manifesto. Chris, thanks for coming on.
Great to be back, John.
All right. First question I want to get into is something about your book, and this is very interesting because I don't know how many people know this, and that is China. You have a section on it being the birthplace of paper money. Would you be willing to just comment or talk about that a little bit?
Yeah, and it's basically said in the subsection. China is the birthplace of paper money. And they tried it countless times with one failure after the next. But every time they were able to just, avoid hyperinflation or anything of that sort, because how we define hyperinflation today didn't come along until pre-revolutionary France. But anyway, they tried, it wasn't just paper money. They tried to make it metals and paper money, but they gave various advantages to those who used paper dollars. And every dynasty eventually fell because they accumulated mass debts and deficits to fund wars against, different dynasties that would attack them, the Mongols and various sorts. So, it's kind of hard to say all this off the top of my head, but that's pretty much the main idea. But eventually they learned and they went back to a silver standard, and that lasted until the late 20s. So they were technically the last to be on a silver standard.
Yeah, doesn't bank in China mean silver house?
Yeah, and a lot of words in countless languages, the word for money is also the word for silver.
That's very interesting. And in terms of paper money, you said it best that China, I think one of the reasons that their citizens buy so much gold, maybe there's more than one, is because they learned the lessons of hyperinflation. The West, even though there's some, it doesn't seem like they fully learned it.
Yeah, and it's really hard to say because it also has a lot to do with their culture. Gold has always been big during the lunar holidays, and their culture advocates savings. Like they have exceptionally high personal savings rate, especially when you can compare that to that of the Western world. So the U.S., we're tepid. I would just say 3.5% plus or minus 0.5% off the top of my head, which is just pretty sad that these things have been lost. And even in China with no interest rates really, just because the RMB has a strong peg to the dollar, they still save. So it just goes to show how much the cultural influence has on their actions and how they save and invest.
Yeah, speaking of savings with China and America, one of the reasons, one thing that most Americans believe, which is false, whether they knowingly or unknowingly believe this, is that spending helps an economy. Do you attribute that thought to a lack of savings in America?
Well, not exactly, because, for example, in China, it's a rather imbalanced economy in that they produce so much, and it's much better in the long run to have a balanced economy where you produce a lot and you consume a lot. And instead, say the U.S., we don't produce anything except for the internet and related technologies. Other than that, we have so many ridiculous policies enacted that just makes it unaffordable to to produce things here and export them.
One other part of the book, also speaking of the U.S., is you talk about the free banking era in the U.S., and I attribute that mostly to the late 1800s. Can you talk about that, when it was? And
yeah, it was the latter half of the 19th century, and basically after Andrew Jackson broke the back of the second bank of the U.S., there was no central bank until 1913. But during that time, fractional reserve banking was legal, so banks could pyramid the money stock 10 to 1. But the market kept that in check and prevented that from happening because of competition. For example, if Bank A engages in a lot of fractional reserve banking, it's very apparent that they're inherently more risky than Bank B, which does little to no fractional reserve banking. So over a short period of time, yes, there were some wildcat banks, but the majority that wasn't the case. Especially as time went on, the market just put its own checks and balances in it, and that didn't. There was over that period of time. I'm not exactly sure about inflation deflation rate, but from 1895 over 1805, the purchasing power of the U.S. dollar doubled. And then you fast forward it from 1913 to present day, with the inclusion of the the Federal Reserve, our central bank. The U.S. dollar is what? It's really worth about 2 cents on the dollar, I would say. So we see a complete opposite of the inflation-deflation argument, and yet, we were thriving in the 19th century and into the early 20th century.
Yeah, it's funny what free markets and falling prices can do to an economy. One other thing I wanted to get into is you're speaking of, you also have this in the book, is deflation really bad? And so deflation is known to clear excesses, strengthening or improve living standards. Why do you think it's so demonized by the press?
Because the government elites, the political elites, the heads of major mainstream media outlets, which have ties to the political elites, they want inflation because people who receive the inflated money first benefit at the expense of those who receive it later. And that's why the U.S. has such a just tiny middle class. That's one of the insidious effects of inflation.
Yeah, if you look at it, a big effect of the inflation, I would say, is not just decreased living standards, but the savings rate. I consider that a product of inflation. If 2/3 of Americans are living paycheck to paycheck, and 1/3 don't even have $10,000 cash in the bank, which, the banks are insolvent, so on the surface, that deep down, that might not actually be a bad thing, but not having $10,000 in the bank, that's there for the wrong, that's done for the wrong reasons.
I'll try to put it a better way. So if you believe deflation is bad, then you necessarily must believe that gains in productivity are also bad. Because, the benefits of gains in productivity is that it lowers your costs of the production of goods and services. and therefore increases the standard of living of society. So if you think deflation is bad, you have to be against gains in productivity, and we've seen remarkable gains in productivity through the technological revolutions, such as the advent of the railroad, the automobile, and most recently, the internet and related technologies.
Now, in terms of deflation and money supply, ever since we left the gold standard, I remember just in our Facebook conversations, you tell this to me a lot about money supply and GDP. That's a very interesting correlation, and it's been proven very accurate. Why don't you tell our audience about it?
Basically, under a fiat monetary system, you need to have accelerating money supply growth to see GDP growth. And when you see decelerating money supply growth, that leads to an economic contraction. And ever since Nixon closed the gold window, it's been 100% accurate in gauging the ebbs and flows of the economy, although there is a 1.5 year to 4 year lag depending on how quickly it decelerated and over what time period it did that or accelerated. So it's a remarkably great, accurate forecaster of future economic conditions. And I'll just, on a side note, so in 2010 or I would say Q3. So I think it was September 2011. Money supply growth year over year peaked at 15.83%. And ever since then, it's been the rate of growth of the money supply has been slowing. So that says that by Q3 2015, the U.S. should be in a full-fledged recession, barring any of more stimulus by the Fed, or whether banks just decide to lend to everyone and their mother.
And speaking of the GDP, do you think later in 2015 that we could see negative GDP?
I actually think Q4 we saw negative GDP, and I think it started actually last year in Q1. The problem is GDP growth is measured by nominal GDP net of the CPI, and the CPI is just, there's so many gimmicks in it. It's actually quite comical, and we go through that in the book. And so I'll just refer to John Williams. He uses how the CPI was calculated in 1980 and then in 1990. And if you use how we calculated it in 1980, the U.S. never recovered from the 2007, the recession that began in 2007. And if you use the one in 1990, maybe there's been a few quarters of 0.5% GDP growth. But in terms of headline GDP growth being negative, I think Q1 will show that, maybe not the first or even second print, but by the third. And if that doesn't happen, definitely in Q2. And this will all result in all this talk with the Fed raising interest rates. I mean, that's such a joke. They have to know that. I mean, although Janet Yellen does look clueless enough to actually believe that nonsense.
Yeah, when I look at the Fed, every time there's even a thought of interest rate hike or the market starts to anticipate it, they always come out with some dovish statement. So your thought on interest rates does seem valid. I would say the most recent is 2 weeks ago. The market, broke its 1800 level, the Dow, and it looked like it was in the mid 17,000s, roughly 17,500. I don't know the exact number, but it seems like every time they have to deal with a anticipation of interest rates, they come out with some dovish statement. One of the reasons I believe is the U.S. economic data that's been coming out. What are your thoughts? Obviously, I know they're bad. What data that we have gotten recently stands out to you the most?
Oh, I don't even know where to begin. I will, just because the most easy to comprehend for most would be real retail sales have just been contracting since December. And that's of great importance because we're a consumer-based nation. 70% of our GDP is consumption. So I think that has a whole lot to do with it. Then we saw new housing starts just absolutely nosedive. I can go on and on, but it's just been that economic data points that were bad and have just continued to grow worse.
Yeah. Well, the retail sales, they've also declined in the face of lower oil prices in the 40s. We haven't seen since 2008. So, meanwhile, the press was telling us this would be a big consumer binge or a big gift to the consumer.
Yeah, that's also quite comical, especially because this is my personal view, but oil is gonna 2 years from now, two and a half years from now, people won't believe how high it is. That's just because if you look at a lot of the oil producers out there, they need, especially those that are taking advantage of fracking, they need about $75, $80 oil just to break even. So the longer period we're at these levels, the higher chances of bankruptcy just because most of these companies are just laden with debt.
Yeah, and then the national oil companies on top of that, a lot of them have government expenditures which aren't counted into our overall cost. So their cost, especially Saudi Arabia, is much higher than what they report, in my opinion.
Oh, definitely.
Yeah. And the other thing is GDP. You already talked about it being negative. How bad would it get if the Fed raised rates?
Oh, it would just go into a tailspin, and that's because, say, the Fed even raised interest rates to the Fed funds rate, the overnight borrowing rate, to 1%, which is historically, just phenomenally low. That would cause the longer end of the yield curve to rise, and because we're a debt-based nation and we need constant debt financing, it would just drive deficits to increase. Our total debt burden would grow that much faster, and most importantly, the interest we would have to pay on newly acquired debt would be much higher because it's not at the our debt isn't doesn't have the interest rate of the Fed funds rate. It's typically the 7 to 10 year yields.
My next question I want to get to is, speaking of interest rates, was the dollar, the Dixie, has gone up really rapidly, some say parabolic lately. I would say it's roughly hit 100 and has now since gone back down to 97, 98. You say this run-up is irrelevant due to investment demand. Can you explain that, what that meant?
Well, I don't think it doesn't have anything to do with investment demand, but if you look at what it's measured against, more than half of it is against one other currency, the euro. which is falling apart as well. And then you got the yen.
I'm sorry, I meant investment metrics, like what it's measured against.
Yeah. Then you got the yen and the UK accounting for, I think, when you add in the euro to that, that's upwards of 80% of the weighting. So when you measure it against these other garbage currencies, yeah, it's going to look great, but it really doesn't say anything. And if people say gold is negatively correlated to the dollar, but I don't know the number off the top of my head, but let's say when the bull market began in gold, I think it was 2002, and silver in 2003. But if you took the U.S. dollar index, which let's just say it was 110, and gold was, let's say, $400 an ounce, why is gold about threefold higher now, and the dollar index, we'll just say, has fallen just 10%? I mean, that's not much of a negative correlation.
Yeah, and gold's done really well since the dollar run up too. Like in terms of it hasn't gone really down much. Today it's at roughly, I believe, 1185. So that's definitely a proof of the point. And speaking of the dollar, and it's also known as the world reserve currency, I want to switch one topic. Is right now there's the Asian Investment Infrastructure Bank being created. Germany, Italy, Britain, a lot of them have want to join. What do you think of this event with a lot of Western European countries wanting to join the Asian Investment Bank?
Oh, I think it's great. It gives competition to the World Bank and IMF, which are complete jokes and dominated by just Western world economies. Meanwhile, the biggest economy, which is now China, aren't in those. So, I mean, that says quite a bit just about, and I think, that is going to be part of the downfall of the U.S. dollar homogeny that currently reigns around the world. And, I wrote an article the other day yesterday that you read, that was posted on SilverSeek, and it just had to do with the tide turning for the precious metals. And a lot of it had to do with all the steps taken to circumvent the U.S. dollar: China, Brazil, China, Russia, Germany, China, Russia, and now the AIIB. And things are with Germany wanting to join, which is the only real productive economy in Europe or in the EU. So this just is all adding up to what will be the downfall of the U.S. dollar, and rightly so, because all the U.S. has done is abuse its status as a world's reserve currency.
Yeah, well, in terms of the world reserve currency, it should really be the creditor nations that get the status. If you just look at it from debt and physical management, the U.S. really doesn't deserve to be the world's reserve currency.
They have it for a long time.
And when it comes to a lot of this Asian Investment Infrastructure Bank, and not only that, you just see a lot of these pegs breaking, like the Swiss broke from the euro. I remember reading, you think this is the beginning of the PM market turning. Am I correct?
Yeah, and I think, it might take 9 to 12 months for a full turnaround. But then beyond that was, the current circumstance the U.S. economy is in, which has, nothing's been fixed since 2008. And the cracks are starting to show, and they're starting to show at an accelerating rate. And you got Germany coming out wanting to join the AIIB, and you have gold investment demand just in China this year alone through the first 10 weeks was, according to Chris Jansen, who I consider the foremost expert on what China is doing and India is doing. There was 505 tons of gold withdrawals from the Shanghai Gold Exchange, and if you net out China's mine production, and that's material because they are the largest gold producer in the world, China still had to import, I think it was 360 or 378 tons in just 10 weeks. So that just goes to show that things are starting to change, and I think they're starting to change in a meaningful way.
Yeah, speaking of Asian demand, it looks like slowly but surely they're trying to relax in 2013 there were some import duties on Indian gold, and it looks like they've gotten rid of some of the rules, and it looks like they're starting to slowly but surely relax them and let the flow of imports come into India. Do you see that?
Yeah, and I see that only because, I mean, not only, but potentially only because the Indian government had a press release the other day saying India's gold demand didn't wane in 2014 because of all the smuggling. So, I mean, the government was just shooting itself in the foot, because if they had low import duties, at least they would get revenue from that instead of it being smuggled in.
Yeah, that shows anytime they put a tariff or something, just a black market forms if you try to block something. And not only that, gold and silver, you're not like importing a good, you're importing something of value. So that's why I thought that was really just ridiculous.
Yeah, then I'll add to that, net silver imports into India for 2014 were, they set another new record after 2013 of 7,063 tons, which is very substantial. And so if you add that plus the smuggling, I mean, India has been really increasing their demand for precious metals. Not what the mainstream press is saying, that, you know, demand fell 42%, or, you know, whatever absurd article that is out there.
Actually, I did read an article where they said that supply was still bigger than demand. And what surprises me is, you know, just go look at Chris Jansen's numbers and you could tell it's not the same story.
Oh, definitely. Yeah, and we don't really know, and China isn't stupid enough to let the public know what the central bank is buying. And they've stated publicly that they want gold to be part of its currency in the future. So, of course, they're buying. We just don't know how much.
Yeah. In fact, they actually moved their main importing from Hong Kong to Shanghai.
Well, now they have, I think, 3 or 4 different places they can import gold into. So it's, I think that was done to make it just more difficult to try to get a handle on what they're really doing. And, you know, that's a very smart move. Try to buy as much gold as you can at the lowest possible price.
So my last question, I would say, is your expertise, I would say, is the miners right now. In your investment career, now you've been investing for quite a while now, is this the cheapest the miners have ever been right now?
That's a difficult question, but I would say yes, but only based on my forward-looking price of gold and silver. Like, I think by the end of 2016, we'll be back in mid to high 30s to possibly breaking 50 again, because it's such a small market. It has and can move, that fast. And I think gold, 1,400 and over. Yes, that's my forecast for 2016, and we'll probably see that in 2015. So if you, it all depends on your assumptions. So on those assumptions, yes, I think they're definitely cheaper than they've ever been.
Okay.
But let me say one more thing. You have to really go in quality, because there's, even with prolonged downturn, there's still a lot of mediocre and subpar mining companies out there that you don't want to be in.
Yeah, a lot of them have invested for growth safe, have high cost mines, levered up with debt. So it's definitely a stock picker's market, in my opinion. So I just want to say, though, thank you for coming on. And if people want to find out more about you and how they can read your book, which also has a chapter of appraising mining appraisal in it, which I think is beneficial to anyone investing in mining stocks, how can they do so?
So the book is on Amazon.com, and you just type in the Silver Manifesto. And if you're interested in our free list for the Morgan Report or subscribing, just go to silver-investor.com or themorganreport.com.
All right. Thank you for coming on, Chris. We'll have you.
My pleasure.